Something extraordinary just happened in the global financial system, and almost no one outside the metals market is talking about it yet. In just a matter of days, gold surged from roughly $4,900 to more than $5,200 per ounce, one of the most powerful moves the market has seen in years. At the same time, silver exploded from $88 to over $104, a dramatic surge that pushed the entire precious metals complex into a completely new valuation range. When you combine gold, silver, mining equities, and related derivatives, analysts estimate that nearly $5 trillion in market value shifted across the metals sector during this move. That is not normal market activity. That is the kind of move that signals a deeper structural shift underneath the financial system. And when something like this happens, experienced investors start asking a very important question. Is this simply another short-term price spike driven by speculation? Or are we watching the early stages of a major monetary transition? Because historically, when gold starts moving aggressively, it is rarely just about the metal itself. Gold tends to react to much larger forces: currency instability, rising debt, geopolitical conflict, and shifting global capital flows. In other words, gold often acts like a warning signal for the broader financial system. And what makes this moment particularly interesting is the speed of the move. Markets rarely add trillions of dollars in value in such a short period, unless something fundamental is changing in how investors perceive risk, money, and long-term financial stability. So in this video, we are going to break down exactly what triggered this massive move in gold and silver, why central banks are suddenly accelerating their purchases of physical metal, and why some analysts believe the precious metals market may be entering a completely new phase. At first glance, a surge in gold prices might seem like something that only matters to traders or commodity investors, but the reality is that moves like this can affect the entire global economy in ways most people do not immediately realize. Gold sits at the intersection of the financial system, currency markets, and central bank policy. When gold rises rapidly, it often reflects deeper concerns about inflation, debt sustainability, and confidence in traditional financial assets. For example, many central banks around the world hold gold as part of their national reserves. When those institutions begin accumulating gold at a faster pace, it can signal that governments are preparing for potential instability in currency markets or global trade systems. Investors watch these signals closely because they often appear before major shifts in economic conditions. Rising gold prices can also influence interest rates, investment flows, and currency valuations. If large institutions begin moving capital away from government bonds or equities and into hard assets like gold, that capital shift can ripple through the entire financial system. In addition, the metals market is deeply connected to industries that rely on silver and other precious metals for manufacturing, electronics, solar technology, and infrastructure development. When silver prices rise sharply, it can increase production costs across several sectors of the global economy. This means that what begins as a financial market event can eventually impact businesses, supply chains, and consumer prices. In other words, the surge we're seeing in gold and silver is not just a niche market story, it is part of a much broader economic narrative involving inflation concerns, geopolitical uncertainty, and the ongoing search for financial stability in a world where global debt continues to rise. The immediate trigger behind this market shock was a rapid surge in buying activity across both futures markets and physical bullion markets. Over the course of several trading sessions, large institutional traders began aggressively increasing their exposure to precious metals. Futures trading volume on major exchanges jumped sharply as hedge funds and asset managers repositioned their portfolios. At the same time, physical demand for gold increased across several major regions, particularly in Asia and the Middle East. Bullion dealers reported increased purchases of gold bars and coins, while central banks quietly continued expanding their reserve holdings. As prices pushed above the psychologically important $5,000 per ounce level, momentum accelerated. Traders who had been betting on lower gold prices were suddenly forced to close their short positions as the market moved against them. This type of situation is known as a short squeeze, where traders rush to buy contracts to limit losses, which drives prices even higher. Silver followed the move almost immediately. Because silver markets are smaller and more volatile than gold, price changes can happen even more rapidly once momentum begins building. The result was a sharp breakout that pushed silver prices above $100 per ounce, a level that had previously acted as major resistance. Once both metals broke through key technical levels, algorithmic trading systems and institutional momentum strategies added additional buying pressure. Within a very short period, prices surged across the entire precious metals complex. What made this event particularly notable was not just the speed of the move, but the scale. When gold and silver rally together with this kind of force, it often reflects large institutional capital entering the market, rather than small speculative trades. To understand why this rally is happening now, it is important to examine the deeper mechanisms driving the precious metals market. At its core, gold functions as an alternative monetary asset. Unlike government currencies, gold cannot be created by central banks, which means its value often rises when investors become concerned about inflation, currency debasement, or long-term debt sustainability. Over the past decade, global debt levels have expanded dramatically. Governments around the world have issued trillions of dollars in new debt to support economic growth, stabilize financial systems, and respond to global crises. While these policies can provide short-term stability, they also create long-term pressure on currencies and interest rate systems. When investors begin questioning whether current debt levels can be maintained without inflation or currency depreciation, demand for alternative stores of value tends to increase. This is where gold enters the picture. In addition, central banks themselves have become major buyers of gold over the past several years. Countries seeking to diversify their reserves away from traditional currencies have been steadily accumulating physical metal. This gradual shift has reduced the amount of gold available in the open market while increasing long-term demand. The result is a tightening supply environment. When prices begin rising under those conditions, momentum can build quickly because there is relatively limited supply available to meet sudden increases in demand. In other words, the current rally in gold is not simply a reaction to short-term speculation. It reflects deeper structural pressures within the global monetary system that have been developing for years. Rapid shifts in commodity markets rarely occur in isolation. When precious metals experience extreme price movements, the effects often spread across multiple sectors of the economy. For businesses that rely heavily on silver for industrial applications, rising prices can significantly increase production costs. Silver is used in electronics, solar panels, batteries, and a wide range of advanced manufacturing processes. When prices surge, companies must either absorb higher costs or pass them along to consumers. This can eventually lead to higher prices for finished products across multiple industries. For smaller businesses operating with tight margins, sudden increases in raw material costs can create financial pressure that is difficult to manage. Investors and financial institutions can also experience significant volatility during periods like this. Rapid market movements can trigger margin calls in futures markets, forcing leveraged traders to liquidate positions quickly. This can create cascading effects across financial markets as capital is moved rapidly between different asset classes. In extreme cases, volatility in commodities can contribute to broader market instability if institutions are forced to rebalance portfolios under pressure. While the metals rally itself may appear positive for mining companies and commodity investors, the underlying economic forces driving the move are often connected to deeper concerns about financial stability. When investors rush towards safe haven assets, it typically reflects rising uncertainty about the broader economic environment. This is why analysts often watch gold and silver markets closely during periods of financial stress. They can serve as early indicators of shifting confidence within the global financial system. One of the key factors amplifying the current metals rally is the growing instability in global currency markets. Over the past several years, major economies have implemented a wide range of monetary policies designed to support growth and manage inflation. While these policies can stabilize financial systems in the short term, they often introduce new risks over time. Currency markets have become increasingly sensitive to interest rate changes, trade dynamics, and geopolitical developments. When investors begin losing confidence in the long-term stability of major currencies, they often turn to assets that are perceived as more durable stores of value. Gold has historically served this role. Unlike fiat currencies, gold does not depend on government policy or central bank decisions. Its value is derived from scarcity and its long history as a monetary asset. As currency volatility increases, the relative appeal of gold tends to rise. In recent months, fluctuations in several major currencies have drawn increased attention from global investors. Rapid changes in exchange rates can create uncertainty for international trade, corporate planning, and long-term investment strategies. When that uncertainty increases, institutions often begin diversifying their holdings into assets that are less directly tied to specific national economies. This process can generate additional demand for gold and other precious metals. If currency instability continues to expand, the metals market could experience further inflows of institutional capital seeking protection against long-term monetary risk. Another factor contributing to the metals surge is the growing level of geopolitical uncertainty across multiple regions of the world. Financial markets tend to react strongly when global tensions rise because conflict can disrupt trade, supply chains, and international financial cooperation. During periods of geopolitical stress, investors often move capital toward assets that historically retain value during crises. Gold has long been considered one of the most reliable safe haven assets in times of conflict or instability. When geopolitical risk increases, central banks and sovereign wealth funds sometimes accelerate their purchases of gold as part of broader financial contingency planning. These purchases can remove significant quantities of physical metal from the market, tightening supply and supporting higher prices. In addition, geopolitical tensions can influence energy markets, trade routes, and manufacturing costs. When uncertainty spreads across multiple sectors simultaneously, investors often become more cautious about traditional financial assets. This shift in sentiment can drive additional investment flows into commodities, particularly precious metals. What makes the current environment particularly complex is that several geopolitical pressures are unfolding at the same time. When multiple sources of instability converge, markets can react in ways that are difficult to predict. This is why analysts are paying close attention to the metals rally. It may reflect more than just financial speculation. It could be signaling a broader shift in global risk perception. When gold begins moving aggressively, it often has implications that extend beyond individual investors or commodity markets. Governments themselves watch precious metals closely because gold plays a role in national reserve strategies and monetary policy considerations. Many countries hold gold as part of their official reserves alongside foreign currencies and government bonds. These reserves are intended to provide financial stability during periods of economic stress. If gold prices rise dramatically, it can influence how governments manage those reserves and plan future monetary policy decisions. In addition, rising gold prices can affect currency markets by altering perceptions of financial stability. If investors begin interpreting gold's rally as a signal of weakening confidence in fiat currencies, capital flows between countries can shift rapidly. These movements can influence exchange rates, bond yields, and international investment patterns. For nations with large gold reserves, higher prices can strengthen balance sheets and increase financial flexibility. For countries heavily dependent on imported commodities or foreign currency financing, volatility in precious metals markets can create additional economic challenges. This is why major market movements in gold often attract attention from policymakers and central banks around the world. They are not just watching the price itself, they are watching what the price movement might reveal about broader shifts within the global financial system. What we may be witnessing today is not simply another commodity rally, but the early stages of a structural shift in how global capital is being allocated. For decades, financial markets have been dominated by equities, government bonds, and currency trading. Precious metals have often played a secondary role in global portfolios. However, periods of financial stress can change those dynamics quickly. When investors begin reassessing long-term risks related to inflation, debt levels, and geopolitical instability, assets like gold can regain prominence within the global financial landscape. The recent surge in precious metals prices may represent the beginning of that shift. If central banks continue increasing gold reserves while institutional investors expand exposure to commodities, the metals market could enter a prolonged period of heightened importance. That does not necessarily mean prices will rise continuously. Markets rarely move in straight lines. Volatility and corrections are always possible. However, the broader trend may reflect deeper concerns about the stability of the current financial system. For investors, the key takeaway is not simply the price of gold today. It is the signal that price movement may be sending about global economic conditions. Markets often reveal important information long before official economic data confirms it. When trillions of dollars suddenly move into precious metals, it suggests that large institutions are preparing for a world where financial uncertainty plays a much larger role in investment decisions.